more information on how you can adopt, go to adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt Us Kids, and the Ad Council.
September is National Preparedness Month, and if you're anything like me, I'm always asking myself why. Why would the government dedicate an entire month to this? I think you and I both know the real reason. It's because when things go sideways, you're on your own. FEMA all but admits they can't save everyone, and their response time just this year has been horrendous. So instead of sitting around waiting for someone else to step in, I'm actually going to do something about it. I found a reliable way to get everything I need to weather any storm. Emergency food with enough calories to keep me strong, along with water filtration, power, cooking, heating. I get it all from My Patriot Supply. They're the #1 trusted source for preparedness items. They actually manufacture a ton of their stuff right here in the US, and they've got over 90,000 5-star reviews. When it comes to my family, I'm trusting the best. Go to mypatriotsupply.com now to protect what is yours. That's
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Inflation and Your Retirement Plan. Mike, why is it so important for retirees to account for inflation in their planning?
Yeah, massively important, and I think any retiree over any course of history will tell you that. And when you experience inflation, when you're on a fixed income, it's tremendously difficult. But even small changes in the rate of inflation, or seemingly small ones, can really lead to massive changes. For example, if you're facing 2% inflation, that means that prices roughly double every 35 years. If you're looking at 4% inflation instead, those same prices double only in 17 years. A huge change to your budget.
And obviously, this also then influences your overall spending habits and your withdrawal rate over time. These are things that you have to account for in your planning. You can't just assume that you're going to necessarily see the same kind of inflation that you've seen previously in retirement.
Yeah, look, I think generally speaking, over the course of the last 20 years, while there have been massive drawdowns in equities, the inflation figure has remained relatively stable. If you're worried about something that could look different from that over the course of the next 20 years, then it's important to really consider what that would mean for you.
Our guide this month is titled Inflation and Your Retirement Plan, and there are two ways you can request it. The first is by calling 800-393-4001, or you can request it online at armstrongadvisory.com. That phone number again is 800-393-4001, or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Tucker with you, and we kick things off today with a little bit of a Jay Powell discussion. Last week, the Federal Reserve got together, and Jay talked to the gang and said, hey, what do we want to do about interest rates? And they all said, yeah, we're going to cut them. And so the Fed cut the Fed funds rate by 0.25% last week. Yesterday, Powell was in Providence, in Rhode Island, actually. Always great to see him up in the New England area. I didn't get a chance to personally stop by and say, hey, purple tie looks good, but I got to, see his remarks, on the streaming thing.
Internet?
That's the one. On the internet, on the streamer. And here's what I find kind of interesting right now. Powell, to me yesterday, came off very much as, hey, you guys kind of missed the point that I was trying to make last week, didn't you? In that, I think really what he was trying to say was, hey, we're going to be cutting interest rates. We think that there are going to be more cuts coming, but there's no free lunch there. That probably means we're going to lose a little bit on the price stability side of things, and you guys got to understand that just because we're prioritizing unemployment doesn't mean we're out of the woods elsewhere. Is that a fair read to you of what he said yesterday?
I think he was putting into plain English what is embedded in all economic models, no matter what you conclude based on them, certainly the models that the Fed uses and that the private sector uses to forecast what the Fed is going to do, which is that in the short term, money is not neutral. When the Fed prints money, it has an effect on the economy. That effect can result in upward pressure on wages and therefore prices. And thank God money's not so-called, thank God money has an effect on the economy. Otherwise, the Fed wouldn't be able to do anything to help us during recessionary periods. But Powell was pointing out that there is in the short term a trade-off between the pressures that push wages and inflation up and the forces that can act after a period of time, nobody knows exactly how long, to put the brakes on economic expansion. You cannot stimulate the economy without risking pushing inflation up. You just can't.
Sure.
Now, sometimes it's so low or there's so much slack that you have room to run. But unless there's a lot more slack than traditional measures of labor market tightness suggest, vacancies, the unemployment rate, and some variations on those, then, as Powell said, we're probably going to result, their actions will probably result in upward pressure on inflation. And inflation is already uncomfortably high relative to the Fed's goal.
The piece that I think is really challenging right now is the more data that I see out there, particularly on the housing side of things. We're really in not a great spot with the housing sector, which tends to be the marginal driver of economic activity in the United States. I mean, when you think about, the difference between recession or not, I think people have it in their heads sometimes that, wow, when the economy goes into recession, it's, this huge drop in GDP and, everything just falls apart. And normally it's a very modest dip in GDP. And a lot of times nominal GDP might not even go negative.
Yeah, that's very rare.
I
don't think it's happened in the modern era when you add inflation, yeah.
I think it happened in 2008.
Oh, like I said, it happened in 2008.
I think it did, but
I don't remember.
I could be wrong. I think just because things got so bad
no,
then.
You're right. Yeah.
But it's usually just that, hey, because, inflation's typically running 2 to 3%, hey, if nominal GDP dips to 1, then real GDP goes negative, and that's kind of the recession that you tend to get in a lot of cases. And so really what we're talking about is, a difference of, a couple percentage points between, hey, the economy's fine and things are bad. And that couple percentage points does result in usually, a difference in unemployment of like 3 to 5%. So there's something that happens there. But when I look at what's going on in housing right now, whether you're looking at the publicly traded home builders, whether you're just looking at the anecdotes that are coming out about housing, most of the country now, aside from the Midwest and the Northeast, is turning into a buyer's market pretty quickly. Now, the problem is because those buyers often need to sell their property in order to buy the new one, because first-time home buyers are still largely priced out of these markets, is that because the housing market is so locked up, you still aren't seeing the volume of transactions rising.
Okay.
It's just kind of pitter-patter, 3.9 million on an annualized basis, 4.1 million, back to 4 million. We're just floating around there, and we're still running about 20 to 25% below the normal pace of housing activity that you'd like to see. So I think ultimately where I got to this morning, and this was kind of a scary thought for me, quite honestly, was, look, the Fed over the last year now has cut the Fed funds rate by 1.25%. It hasn't done anything to help housing. It's done effectively
I see
nothing.
I see your point.
And this is for a combination of reasons, some of which I've mentioned, but also, hey, you still have property taxes that are rising in much of the country. You still have insurance premiums that are rising in much of the country. You still have utility prices that are rising in much of the country. And so, the piece that I think I look at here is, okay, mortgage rates may have come down 0.5% in the last year, which means that a mortgage that had, principal and interest payments coming in at $2,000 a month is now $1,900 a month. Okay, great. You got a little bit more wiggle room, that's good. But if property taxes went up by, $300-400 for the year, and your homeowner's insurance premiums went up by $600-700 for the year, and your utility rates went up by a few $100 for the year, that savings on the mortgage has been completely eaten up by all the other stuff that just went up. And so it's something where I look at it and I go, look, what would it take to get housing actually moving again? And you kind of start talking about, hey, if you're really concerned about housing, you start to get kind of aligned then with Stephen Miran's view of, yeah, you might need to get the Fed funds rate down to somewhere in that 2% range before you finally, get things really budging. The problem is, hey, what does Fed funds at 2% do to the inflation side of the equation? Because housing is not the only thing that matters in the economy. It's the marginal driver of economic activity. But all the other stuff, you start trying to juice demand with, the Fed funds rate at 2%, do you end up with inflation at 4% in short order?
If you think we have a demand problem, that the Fed can do something about. It's easiest to think about the Fed as sort of a thermostat. It cools demand when it's too hot. It can stoke demand when demand is flagging and the economy is thus slowing. So the genesis of the slowdown in demand, if you think there is one, might be housing. And if you put a lot of weight on that proposition, housing slowing, this is going to be bad for consumption and bad for investment. There's an investment and a consumption component to it. They are both they are two big components of GDP. That's not to say they drive growth in the long run. Those are two different things, but let's keep this simple. Then, yeah, I guess you could get to, we need to do something about demand. We need to stimulate it. So you should lower the Fed funds rate more. That's a reasonable point of view. His assumptions are aggressive, and they conveniently align with the orders he almost certainly got from the administration for which he still works that put him where he is. That's what clouds this and makes it especially complicated and thorny. You cannot overlook the political pressures right now. That's not to say there might not be a good argument for cutting rates, though. I simply don't know. I do know inflation is elevated, unemployment is still low, and GDP appears to be growing at or above trend. Those facts, which we have in front of us, they're concrete, don't exactly scream for an aggressive rate cut.
Let's take a quick break, and when we return, let's talk a little bit about what we've been seeing in the market over the last 4 or 5 months, right after this.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Marc Vonner is the CEO of Veterans Development Corporation. Marc faithfully served his country from 1981 to 1984, and we're thrilled to have him as a partner and presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family that includes his father Victor and brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and it's one of the main reasons he chooses to give back to this special community. Marc is honored to continue the legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the Disabled American Veterans Department of Massachusetts. You can join Marc and help our great American heroes today by making a donation to support the DAV Department of Massachusetts. Please visit dav5k.boston. That's dav5k.boston.
Every dollar you've saved in retirement accounts and life insurance tells a story of hard work, smart choices, and the future you envision for your family. One way to help that story end well is to make a beneficiary choice that does more. This month's free guide from Cushing & Dolan, IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection, explains how naming your estate as the beneficiary of your IRA or life insurance can add a layer of tax efficiency and nursing home protection, while still allowing your spouse access when it matters. It's about keeping more of what you've built working for your loved ones now and in the years to come. Get your free copy today by calling 866-848-5699. That's 866-848-5699. Or you can request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Well, discover the magic of the U.S. Virgin Islands. St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visitusvi.com.
The S&P 500 has now gone 107 sessions without a 2% daily drop. That is the longest stretch since last July. There have been 2 longer stretches in the past decade, the other one ending in early 2018. Both of those, the last July one and the 2018 one, lasted about 350 sessions each, which is over a year. Remember, there's about 250 trading sessions in a given year, and so you're talking close to a year and a half in both of those cases. Generally, you usually see a 2% drop happen in markets. Again, there's no like hard and fast rule, but a 2% down day, if you look just at the distribution, you're talking about having a handful of them in a given year. Anywhere from 3 to 10 is kind of the range in a normal year that you would see. So there are a couple things here that this means, obviously. The first is that with markets, you might recall back in kind of that February through April time period this year, one of the things that we tended to say a lot was, look, when you have market volatility, it tends to beget more market volatility. Volatility tends to cluster in markets. Likewise, a lack of volatility tends to as well. And some of this is a more recent phenomenon simply because of different trading strategies and different investment strategies that really focus on volatility targeting and things along those lines, and that focus on kind of trying to have a mechanical construct for how volatility appears in a portfolio, such that, hey, if you're seeing more volatility in markets, it, directs the investment strategy. Okay, you need to degross and pull back because you have too much vol in your portfolio for, how much, you want to take on. And so you can kind of spiral in both directions. So the question on this, obviously, is, hey, how long can this go? Because no market has ever gone, an infinite number of days without a 2% dip. And the question that is popping up in people's mind now is, hey, it's been a while and stocks are at all-time highs. Is this market getting, really nervous? Is this market getting really dangerous? You then get to this piece from Barron's. The S&P 500 has been on a tear. History says this rally is due for a pause. And to which I say, Not necessarily, and I'm not sitting here telling you that stocks never go down. I'm not sitting here telling you this rally is going to go on, but as I've said a lot with this whole AI phenomenon that's been the main driver of these moves the last few years, look, the tech bubble had plenty of opportunities where you could have said, okay, maybe it's time for this to take a break, but it ultimately didn't start breaking down for good until 2000, and you had a whole lot more opportunities to make money riding the bubble up than you did trying to predict exactly when it was going to pop. And I have no idea what you're going to get in this case as well in terms of when this market actually gets long in the tooth instead of people just writing about, well, maybe it's long in the tooth now.
Yeah, as you can imagine, very sophisticated attempts have been made to model the frequency of pickups in volatility. If you knew when markets were going to become more volatile, or if you knew when markets were quote unquote due, there would be a way to parlay that into making money, to turn that into an investment strategy. Similarly, people try to predict recessions for similar reasons. There is no relationship, though, between the duration of an expansion and the occurrence of a recession. It doesn't become more likely, for example. People have looked at this over and over. It's a natural question to ask. And over, the idea that the longer, for example, the economy expands or the longer a market goes without having a 1 or 2% dip, the more likely one becomes, or the more severe the dip eventually is. No real reliable relationships there. And who would be interested in volatility? I wanted to make a point about that too.
Go for it.
If you're a business and you have a pension fund, it's rare, but they're still out there. You have to make contributions if your pension fund doesn't grow at the rate you and your actuaries assumed. So you're very concerned about market dips and volatility, because volatility swings both ways, up and down. Because in the event that you don't hit your assumed rate of return as a business for your pension fund, you have to put money into it. That comes out of earnings. That affects you. It affects shareholders. So for you and I and anybody with a 401k, volatility is annoying. You'd rather have a nice steady 8 to 10% a year, but that's not the way the world works. But for some investors, and I'll use pension funds as an example here, it has real-world consequences.
Yeah, it's the, volatility, it is the price of admission to get the rates of return that you get in equity markets. You cannot avoid it. You can transform it, but it never goes away. It just transforms and becomes, it shows up somewhere else if you try to get rid of it. So I think that when we look at what we're seeing in this market, yes, stock prices are elevated. Yes, they have been on an absolute tear over the last 5 months. Yes, volatility is very low, and those are all things that can make you nervous. But the question that I think you ask is, okay, this was all true 2 or 3 months ago, and the S&P was 6-7% lower.
Yeah.
So if it didn't go down then, what's going to make it go down now? And I'm not saying that it will or won't, because I have no idea what the market's going to do tomorrow, the week after, the month after, the year after. I have no idea. But it always bothers me to see, the writing that's out there either saying, well, this is, what we're seeing in these stats, and that means that this is what comes next. Nothing ever always comes next in markets. A year ago, we were talking about the SOM rule and how, well, there's, never been a SOM rule trigger without a recession. And lo and behold, we had a SOM rule trigger without a recession at the end of last year. So I think that if none of this is physics, I say that a lot, but there are no, laws of physics to markets. There are some, general guidelines and things that you can pay attention to, but there's nothing that's hard and fast. There's no, this is the speed of light for markets. There's no, this is, how fast gravity on Earth causes an object to fall for markets. There are some things that you can pay attention to and things worth noting, but ultimately understand that, hey, things can move in unexpected ways and for longer than you expect in a lot of cases.
Yeah, the only rules you can almost take to the bank is that nothing can grow faster than the economy forever, like our debt, for example. because eventually we wouldn't be able to repay it. It would become the whole economy. And that's true of stocks, too. They can't grow faster than the aggregate growth rate forever. But you're right. The difficulty in predicting things is that past relationships change, so you can't use the same factors that would have been effective in the past to make predictions to make them in the future, because people figure it out, and it makes them useless.
Let's take a quick break here. When we return, we're going to do a little bit of Wall Street Watch, and then we're going to be joined by Todd Lutzke from Cushing & Dolan here to talk a little bit of estate planning next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. This month's free guide from Cushing & Dolan is called IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection. Learn how naming your estate a beneficiary can reduce estate taxes, protect assets from nursing home costs, and avoid the 5-year Medicaid waiting period. Call 866-848-5699 to get your free guide today, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest risks to retirement isn't just market volatility, it's longevity. People are living 25 to 30 years after they stop working, and that gives inflation plenty of time to work against you. At just 3% inflation, your expenses double in about 23 years. Add to that the fact that healthcare costs typically rise faster than general inflation, and your later years could be your most expensive. Without a plan, that combination can put real pressure on your savings. That's why we've put together a brand new guide called Inflation in Your Retirement Plan. The guide shows you ways to balance longevity risk with rising costs and strategies that may help you make your money last through decades of retirement. Call 800-393-4001 to get your free copy today. 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva with the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to deal with qualified retirement plan assets, and can they be transferred to these irrevocable Medicaid trusts?
So this is a tough asset in general. When you're dealing with retirement plan assets, it's difficult from an estate planning standpoint or a Medicaid planning standpoint to deal with them. Why? Because they have both an income tax component and an estate tax component, right? They're taxable when you take them out, and when you die, they're subject to your estate tax. So the general way to do this would be, one, you can name the spouse as the beneficiary of the IRA, or you can name the kids the beneficiary of the IRA, or sometimes you can name the trust the beneficiary or the estate the beneficiary. But it all depends on the size of your estate, the size of the IRA. But the one thing you really can't do is you can't take the asset and transfer it to the irrevocable trust or revocable trust while you're living. Otherwise, it will create a income taxable event. So tough to plan for those in advance unless you name the estate the beneficiary.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide called Why Name Your Estate an IRA Beneficiary right now by calling 866-848-5699. That's 848-5699, or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, after the S&P 500 snapped a 3-day winning streak and we saw a slight pullback from Nvidia yesterday, markets are really quiet. Right now, the Dow is up only 0.1% or 41 points higher. S&P 500 dipping by 2 points. NASDAQ also dipping by merely 11 points. Russell 2000 is edging higher. Not much movement there. 10-year Treasury yield up 1 basis point at 4.133%. And crude oil is up 1.6%, trading at $64.43 a barrel. And Nvidia shares, by the way, are currently flat. Alibaba, on the other hand, jumping over 9% after the Chinese tech company said it will boost spending on artificial intelligence models and development to more than $53 billion. Sticking with tech and AI, where Micron reported its revenue soared 46% last quarter, driven by demand for AI developers. Micron's outlook for the current quarter also beat expectations. However, Micron shares are down nearly 2%. Meanwhile, shares in Lithium Americas surging 88% after Reuters reported that the U.S. is negotiating a stake as large as 10% in the Canadian mining company. Lithium Americas is also developing a mine with General Motors, sending shares in GM up by 2%. And according to Bloomberg, Oracle is seeking to borrow $15 billion from the U.S. investment-grade bond market today as the software maker ramps up its spending to meet the needs of the AI boom. Oracle shares are down about 2.5%. I'm Tucker Silva, and that is Wall Street Watch.
This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutzke is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutzke.
As promised, we're joined now by Todd Lutzke for Ask Todd. We got phone lines open so that you can ask Todd your estate planning questions. The number is 888-205-2263. Get calling to make sure that you get space in line because, golly gee willikers, we can usually only get through 2 to 3 questions during the segment. Again, that number is 888-205-2263. One more time, that number is 888-205-2263 to ask Todd your estate planning questions. Mr. Lutzke, how are you doing today?
I am doing great. How about yourself?
Doing pretty well. I yesterday actually I robbed the oversized board game store, believe it or not.
Yeah?
It was a huge risk I was willing to take.
Right.
Todd, I want to talk to you today about real estate and passing real estate on to the next generation. Is it possible to put a beneficiary on a piece of real estate generally?
Well, the answer is yes. You absolutely can do it, but I would never do it. And it's not really adding a beneficiary. So let me sort of say yes, but it's not really called adding a beneficiary, right? You add a beneficiary to like an IRA or to a 401k or or even to an investment portfolio, right? You can add a beneficiary, but you can't really add a beneficiary to a trust. I mean, to a piece of property. But what people do, which is actually worse, is they tend to put someone's name on it, right? I've actually had people who would say, in fact, I'm dealing with one right now. It was strange. The siblings came in and they said, we believe that one sibling is now moved in with us. They have, unfortunately, some cognitive issues and they need some help. And we just want to make sure we can start doing some planning before it gets too bad and protect this house. But we're fairly certain that this house was meant to be given to all four of us. Sure enough, I checked the deed. It went all to the one sibling who's starting to have the cognitive disability into a trust by that person. So that person owns it 100% because it did have more than one name on it. And then they gave it to her. She then put it into this trust, and this trust said for her life, she has 100% ownership. And then when she dies, it goes to these siblings. And I'm like, right now, that's how it's owned. It's really her property. Oh, well, we didn't mean that. But unfortunately, if she gets sick, the government doesn't care that you didn't mean that. That's how it's owned. And if you try to transfer it now because of an oopsie, a couple years ago we made a mistake, it's still going to look like a 5-year waiting period for Medicaid eligibility today. So I said, here's how we have to sort of plan it. But to my point, I didn't mean to get off track on that, and I'm not sure I did, but that's what you run into when you start talking about real estate and naming a beneficiary, right? They don't. They actually change the name on the deed. And so when you do that, they become an owner. So if you say, I decide to put my son on as a 50% owner, you didn't add a beneficiary, you gave him a 50% ownership. And why the ownership is so different than beneficiaries' designations is, one, well, obviously, they own it. That kid gets divorced, has a financial problem. There's going to be a ramification because that asset is theirs. They get sick, go to a nursing home. It's their asset. So you can't hide that. It's theirs. Perhaps you've made a completed gift when you did this as well. So you have that problem that goes with it. You've carried over the basis for tax purposes. You've got those problems because now if I bought it, but I bought it for, $200,000 and it's worth $1 million and I give it to my son half, well, his basis is $100,000, half of my basis. So now I've trapped capital gains tax problems in doing this. So, if I want to sell it, I can't. I need two people, two different signatures. On and on with the problems, right? So great question, I think, Chuck, because people really confuse this. Let me quickly tell you, with a beneficiary designation, you don't have any of those problems. Why? Because they don't own it. They don't get it until you die. They're not on the account. They can't open the account. They can't take money out of the account. They can't manage the account. They're just a beneficiary when you die. So you don't have any of those tax problems or any of those control problems. So great question. I think it sometimes really needs to be explained.
Talking with Todd Lutzke from the law firm of Cushing & Dolan. Still room on the phone lines for you to ask your estate planning questions. 888-205-2263 is the number. Again, that is 888-205-2263. Let's take a quick break right now, and when we come back, we're going to get right to your questions with Todd then. That phone number is 888-205-2263. One more time, it's 888-205-2263.
Ask Todd with Todd Lutzke every Wednesday at 10:30, only here on the Financial Exchange Radio Network. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte-Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Artificial intelligence is changing the way companies invest and how markets move. Add to that global trends like international outperformance, a weakening dollar, and shifting bond yields, and you've got a complex landscape for investors. This is Mike Armstrong from the Armstrong Advisory Group, and we're hosting 2 financial seminars this fall to help you understand what it all means. Join us at Margaritaville Resort, Cape Cod on October 9th, or at the Showcase Superlux in Chestnut Hill on October 16th. Call 800-393-4001 to reserve your seat. We'll talk about how diversification and preparation may help you navigate uncertainty so your plan is ready. Don't miss this chance to get a clearer picture of your financial future. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
You're listening to Ask Todd with Todd Lutzke on the Financial Exchange Radio Network.
Still a bit of room on the phone lines if you want to ask Todd Lutzke any estate planning questions. 888-205-2263. That number again is 888-205-2263. Let's go to Mary in Buzzards Bay. Mary, you're on with Todd Lutzke.
Hi there. Can you hear me okay?
We certainly can. What's your question for Todd, Mary?
Okay, so what I explained, before you got on, is soon we're going to be, my mom passed away about a year ago, and we're very close to closing on her property. And before her death, I've got 2 remaining siblings. Originally, there were 5 of us siblings. 2 passed away in 2020. So the 3 of us, we before our mom died, we each owned 20% of her real estate, and the remaining 40% from the 2 siblings that passed away each went back to ownership of my mother. So we know that we're going to have to pay capital gains on the 20% that we each, already own. My question is, on the 40% that soon will be divided amongst us three remaining siblings in the family, do we have to pay capital gains on that? Unfortunately, the house is worth a lot of money, which is good, but the bad side is my father, when he gave us the 20%, he did not do it the right way. So we know we're going to get slammed on capital gains on the 20% each. But again, on the remainder 40% that'll be divided amongst three of us, how does that work? Will we have to pay a lot on capital gains on that, or is it?
So stay on the phone and let me ask you a couple follow-up questions, because there was a lot of information that you just gave, and it's not easy to follow. I'm not adding up the numbers correctly. So Dad gave you 20% to two people before he died, so 40% was given to you and your sibling?
20% each was given to my siblings and I before our mother passed away.
Now, before your mother died, you guys got there was 40% gifted, correct?
20% each we owned prior to our mother's death.
Well, the answer is yes. The answer is yes. 40. So the answer is 40% was gifted before your mother died. 20 to you, 20 to your sibling. That's 40%, correct?
No, there's two. We each got 20%. There's two other
so that's
siblings
40%.
besides me.
So 20 and 20 is 40%.
Right.
I just can't make sure I understand the numbers. If you got 20% and your sister got 20%, that's 40%, correct?
No, what it is you're not hearing me, I don't think, well. 20% per person. There's two siblings and myself. There's three of us that each got 20% prior to our mother's
60%.
passing.
Okay, so that's 60%.
Correct. And then what happened is when my mom died, before she died, two siblings, other two siblings passed away. There's still three of us in the family left. So my mother inherited back.
I got it. I got it now. Thank you very much for that. That was very helpful. So now I understand 60% was given away before Mom died, and 40% was not, but that 40% is going to these other people who have already died, so it's going to probably pass down to their kids. And so that 40% is going to get a step up in basis for capital gains tax purposes. So you're absolutely right. But I think to help limit the capital gain, let me just ask you this. How was the property owned? Is your dad alive?
No, he died before my mother.
So when your dad died, the property was owned jointly between your mom and your dad, right?
It was joint, yes, but they had put it in their kids' names. So
then it wasn't joint. All right. So then it wasn't joint. I was just trying to get a step up in basis when Dad died, but it sounds like it wasn't jointly owned by Mom and Dad 100% when Dad died, correct?
I'm not sure of that. I do know that all of us siblings, there were originally 5 siblings in the family, and we all owned 20% each. So our parents were actually off of it for the 5-year look back. And then what happened is, unexpectedly, 2 siblings passed away. So then my mother got back ownership of 20% ownerships from 2 siblings who passed away.
Oh, so it actually went back up a generation rather than down. So it sounds like you guys gave it all away. Mom and Dad gave it away, reserved a life estate, and then one of the kids died. 2 of the kids died, and so a portion went back up to Mom, and that's why Mom ended up with 40% on her death, which actually turned out to be tax beneficial. I'm not happy about 2 siblings dying, but from a tax perspective, that 40% will be a step up in basis. So it's going to help you a little there, but you are right. This is why we don't give things away, folks. This is exact. You almost answered your own question, but ultimately we don't want to give things away during life because you have this basis problem, right? And life estates give you so little control while you're alive in terms of selling it and moving, and creditor issues. I don't love it, but for here, it actually created a tax problem. So you're right. When you go to sell this, 60% will be capital gains at a higher rate, whatever the carryover basis was when you guys got the property from your parents. And 40% will get the fair market value date of death as a basis. So interestingly enough, the people who are inheriting that 40% will have probably zero capital gains tax, and you guys will have to pay capital gains tax. So it's unfortunate, but that's how the prorating will work out. So yeah, folks, this is why, great question for sure. Great question from Chuck. Real estate's complicated, folks. In fact, estate planning can be complicated. And that's why this guide, this is just for real estate. The thing we're looking at here is IRAs and life insurance. Also extremely hard to deal with estate planning. Who do we name as the beneficiary? They're complicated because they have an income tax hit and an estate tax hit. So you got to plan for both. So in this case, you can name if you're over 73, that's a requirement, but it's possible to name the estate the beneficiary of an IRA and shelter it for estate taxes, while at the same time protecting it from the cost of long-term care in the event you die and just never go to a nursing home. So it can be saved for the surviving spouse and can be done without any adverse income tax consequences. Call and get the guide, folks. That's what it's all about. Naming your estate an IRA beneficiary, 866-848-5699 or legalexchangeshow.com. Learn how to do it and how to do it with IRA or with life insurance. 866-848-5699 or legalexchangeshow.com.
Mr. Lutsky, I appreciate you joining us today. Thank you so much for the time.
Always a pleasure. Thank you for having me.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated.
Still a bunch to come as we continue through the show. We're going to be talking a little bit more about what's going on in the labor market, which is showing continued slowdown. Is that slowdown going to develop, into a larger problem, or are we, maybe getting near the end of it? We'll discuss that. We'll be talking a little bit about Nvidia and the problem that they have. Too much money. We should all have that one. And then also going to be talking a little bit more about what we are seeing from gold these days. It's been a story we've covered for basically the whole year with some tremendous performance in the yellow metal. We'll talk a little bit about why it may or may not continue. So we still got a bunch to get to in hour two. All that and more is going to be coming up. Stick with us. Back in a bit.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams, your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte-Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month on the topic of inflation and your retirement plan. Mike, a lot of people listening might be familiar with the idea of the Consumer Price Index, the CPI, but rare is it that we find someone whose own personal rate of inflation exactly matches the CPI consistently.
Of course, we all have different spending habits. We all live in different parts of the country and have different effects of inflation. But I think a great example here, Chuck, is during a large portion of the 2010s decade, CPI was relatively in control, and people got very little in the way of increases on their Social Security. However, healthcare inflation was pretty hot, and Medicare prices went up pretty dramatically during that period of time. And that is one area that dramatically affects retirees that doesn't play into CPI all that much and resulted in people seeing their Social Securities just not growing a whole lot during that 2010 decade. And so you really do have to evaluate the risk of, hey, here are my spending categories, and how might things like changes to the labor market or changes to energy markets, if I live here in the Northeast and I can't get natural gas and I'm instead relying on oil prices, how could those changes really affect my future finances?
Folks, our guide this month is titled Inflation in Your Retirement Plan, and the way to request it is by calling 800-393-4001. You can also request it online at armstrongadvisory.com. The guide again is Inflation in Your Retirement Plan, and that phone number to call is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts. Do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Tucker with you here, and stocks stuck in neutral today. The Dow Jones Industrial Average is up 25 points. The S&P is down 2. The NASDAQ down 9. So not much of anything going on in equities. Bonds, not much different. The 10-year Treasury is up 1.1 basis point. Yahoo! And when we look at what's going on in commodity markets, we got West Texas Intermediate up 95 cents a barrel to 64.36, so a little bit of an upward move there. And then with gold down $30.70 an ounce to $37.85. I guess it's got to take a break sometime. And today happens to be, at least one of the times when it's taking a break. But overall, pretty quiet markets, pretty quiet news day. Only things that we've gotten today: a little bit of mortgage application data, which continued to strengthen very modestly week over week after a big jump last week. And we got new home sales data that came out at 10 a.m. They showed an unexpected big jump from 0.65 million, 650,000 units on an annual basis in the prior month, up to 800,000. I don't see any other supporting data out there that shows any real strength in the housing market. So for now, I'm kind of just chalking this up to some kind of anomalous reading because really there's nothing else in housing that seems to be showing any meaningful signs of life. And so I kind of look at this and say, okay, file it away, but most likely we're going to see some kind of regression next month. If we happen to see more strength, okay, maybe there's something there. But for now, I can't really square this with anything else that I've seen in housing. And so it's a good data point, but it doesn't really mesh with the whole rest of the picture in housing. Top story this hour, and where I want to kick things off, is this piece from the Financial Times. More trouble lies ahead on the U.S. job front. And it's talking more about this in the context of, the Fed, obviously, and the cutting that they did last week on interest rates. But in terms of further concerns for the labor market in the next few months, Marc, couple things that they put out here in terms of, things that you need to watch for. Hey, number one, you've got a bunch of job losses in the government sector that are going to be showing up in the next month or two, just because a lot of those people that were part of the Doge cuts back in the spring, they were on a 6-month deferral, and so a lot of those people are going to stop being paid pretty shortly. Other things that are going on, you have continued potential drag from AI slowing hiring. You've also got surveys that are out today showing the thing companies are most concerned about today is weakening demand, which obviously tends to impact hiring because demand leads hiring. So that's obviously something that you need to watch on that side of things. And this piece also gets at the thing we've talked about on the labor supply side, which is, look, for pretty much all of the economic data that we have in American history, labor supply has never been a limiting factor for job growth. It's always been labor demand. I'm sure if we had, data from the 1860s, it would obviously show something different. But given the, the limitations on data that we have, labor supply has never been a limiting factor. But today, when you have baby boomers continuing to retire in larger numbers than they are being replaced by from Gen Zers, and you have deportations and fear of deportations taking a number of immigrants out of the labor pool, you look at this and you say, hey, you've got this weird situation where, there's really slow job growth right now, but it might actually be matching what we're seeing on labor supply. And so it kind of raises questions about exactly how the Fed's going to act given the uncertainty about where labor supply goes in the next 6 to 12 months.
Yeah, I guess as others have noted, that may make the unemployment rate a bad indicator of slack in the economy, because it could, if you think of it as a ratio, which it is, and the growth in the top part of the ratio could equal the growth in the bottom part of the ratio. There could be both very low levels of growth, so the ratio doesn't change. So it's not really telling you what's going on. Vacancies might be a better indicator, or payrolls might be a better indicator. I really don't know, but it clearly distorts what used to be a reliable signal on what the Fed used to depend on to determine whether or not it needed to rein in versus goosing demand, which is the way it acts on the real economy.
When we look at the place that tends to get people nervous when it comes to hiring, construction's always one of the ones that tends to roll over in recessions for obvious reasons. When you talk about major expenses, talk to either any family or any business and ask them, hey, how much does real estate make up of your monthly budget? And generally, they'll say, it's one of the 2 or 3 biggest line items, depending on the exact, people that you're talking to. So what we have here right now is a case where if you look at the year-over-year construction, the year-over-year growth in construction employment, and just kind of look at this as it's gone through this cycle. So I'm excluding, kind of the whole 2020 window for obvious reasons. But if you look at, starting kind of mid-2021, you had construction job growth running at about 2.8% year over year in August of 21. That actually went up as high as 5.01% in July of 22. Hey, we got more construction going on. We need more people in the construction industry. Hiring is up. Since July of 2022, the pace of hiring has slowed. By July of 23, I'm just going to kind of go year over year here. It went from 5.01 to 2.88% year over year growth. By July of 24, it was down to 2.49%. So again, still fine. Like, those numbers are not bad. They're perfectly acceptable in a normal economy. But it's really that in the last year or so, we've now gone from 2.49% year over year growth down to 0.7% year over year growth. And that's a pretty stark deceleration there. And I was looking at the data this morning, and since the data set that we have, fortunately, it goes back to 1940. Since World War II, construction job growth, aside from the World War II period, which I'm going to exclude for, again, obvious reasons, a lot of people in the construction industry went overseas to fight, so there was obvious contraction then. If you look at the last 85 years, year-over-year construction job growth has gone negative 16 times during that time. In 12 of those instances, there were recessions. Mm-hmm. And it's because construction is a huge driver of marginal economic activity. And so when you start to see construction rolling over like this, even though employment as a whole tends to be a lagging indicator, the construction industry is a leading indicator, and construction employment to a certain extent is a coincident indicator with recessions. So the concern that you have if you're watching this is, look, if construction jobs numbers go negative year over year, that's usually not a good sign for the U.S. economy and for the labor market, as it relates to it, simply because labor, aside from construction, tends to be a lagging indicator. And so the job losses usually come, as you go through the recession, not in advance of it.
In a lot of ways, this is feeling like a traditional pre-global financial crisis, pre-08-09 business cycle. We've forgotten what those are like. But typically, coming out of a recession, the Fed has lowered rates by a lot during the recession. That stimulates demand. Yeah. That boosts all kinds of employment, including construction, and thus housing activity and all the incidental and knock-on effects associated with that. At some point, rates have been too low for too long. The Fed has to be, and inflation begins to tick up. It makes things uncomfortable for politicians and policymakers. The Fed wants to preserve its independence and do a good job, so it raises rates and slows the economy, usually raises rates too much because it's impossible to gauge these things precisely, and the cycle repeats. This is feeling more like a traditional business cycle. The Fed may have left rates too high too long, though I don't think there's evidence of that in other important pockets of data. We'll see. But as long as nothing hits us from out of left field, and that's a very dangerous statement to make, those are famous last words, this will probably unfold like a typical business cycle. The Fed will have to continue to lower rates in order to avert recession. The challenge here, much like in the 1970s, is inflation is elevated, so you might induce a recession, but that might not bring down underlying inflation.
Let's take a quick break. When we return, we've got some trivia, and then I want to talk a little bit about Nvidia and the stories that we've seen the last week or two surrounding the AI space. Just some interesting things that are giving me tech bubbly vibes. But, you'll have to wait until after the break to hear what those are.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. This month's free guide from Cushing & Dolan is called IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection. Learn how naming your estate a beneficiary can reduce estate taxes, protect assets from nursing home costs, and avoid the 5-year Medicaid waiting period. Call 866-848-5699 to get your free guide today, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte-Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Are you wondering where the economy is headed? GDP is growing, but tariffs, inflation, and job numbers are making headlines. Interest rates, housing costs, and policy changes are impacting all of us. Even AI is changing how markets move. Hi, this is Chuck Zodda from the Armstrong Advisory Group. We're hosting 2 financial seminars this fall to help you make sense of it all. Join us at Margaritaville Resort, Cape Cod on October 9th or at the Showcase Superlux in Chestnut Hill on October 16th. To reserve your seat, call 800-393-4001. We'll break down the economic trends, market risks, and smart strategies you need to plan for retirement and beyond. Diversification, preparation, and smart decisions are several of the keys to navigating uncertainty. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
All right, time for trivia here in the Financial Exchange, and we're going to continue our sitcom theme this week. One of the most popular sitcoms of the 60s was Bewitched. Bewitched starred Elizabeth Montgomery as Samantha and Dick York as Darren. Dick York was replaced by Dick Sargent as Darren for the show's final 3 seasons, and in 2005, Bewitched was remade as a movie starring Nicole Kidman as Samantha. So our trivia question today, which actor portrayed Darren in the 2005 movie Bewitched? Once again, which actor portrayed Darren in the 2005 movie Bewitched? Be the fifth person today to text us at 617-362-1385 with the correct answer. You win a Financial Exchange Show t-shirt. Once again, the fifth correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
So, a couple days ago, we got the headline that Nvidia was going to invest up to $100 billion into OpenAI. The additional detail that we've gotten, it's going to come in these $10 billion tranches to allow OpenAI to try to build out more compute capacity so that they can finally build the computer that ends the world. You know, that's the goal in this is give us the computer that's smarter than us that decides we don't need you anymore. And, you know, okay, we'll see what happens with all this. So, immediately upon seeing this, and granted, I was not, you know, the mature, you know, weathered veteran that I am today, but it immediately gave me flashbacks to the tech bubble, because what we saw in the last, you know, kind of the waning year or so of the tech bubble was something called vendor financing. And vendor financing was what companies like Cisco and... Do you guys remember Nortel?
Mm-hmm.
Yeah.
No.
You don't remember Nortel?
No.
They were... I'm trying to think of how big they got when they were finally... Are they even still around now? No, they're not. Of course not.
No, they filed for bankruptcy in 2009, and they ceased operations in 2013.
Oh, okay. The bankruptcy was settled in 2017.
Oh, okay, sorry.
But they were a telecom and networking equipment manufacturer. Surprise, they were around in 2000, just like everyone else. That's what they did. And as we got towards the end of that cycle, companies like Cisco and Nortel, they went through this vendor financing cycle, which was pretty much, hey, we're going to give our customers credit in order to buy our products. And generally you look at that and you're like, okay, so it meant that these companies had money, but it also meant that their customers didn't have the money to buy their products, and so demand was going to slow down if they didn't basically give their money to the customers to give back to them. It's pretty much what it was. And this peaked, by the way, at around a $25-30 billion run rate in 2000. This according to a piece from Newsweek that I found. And so you've got Nvidia today saying, hey, we're going to give OpenAI up to $100 billion so that OpenAI can give $100 billion back to us in order to buy chips. Okay, so do you actually make any money in doing that? Well, no, but it's the thought that counts, is kind of how it ends up being. And I just kind of look at this, and it makes me feel very nervous about where we are in the cycle. Not that Nvidia is going to go out of business, because, again, while Nortel did, there are plenty of tech bubble legacy companies that are still here. Whether you look at, Dell or Cisco or Intel, and these aren't, bad companies or anything. I mean, you can even say, like, until the last couple of years, Intel was generally pretty good, and then they just kind of fell off a cliff starting in, 2019. So I just kind of look at this, and it makes me nervous about where we are in the cycle, because anytime, like, Mark, let's say that you're Italian like me, okay? And let's say that I make the best pasta. It's just...
Whoa.
It's no. I got it all going on. Like, my pasta is top notch.
Okay.
And
I'll let you explain that to my mother.
It's fine.
It's better than hers. Better than hers. Okay.
It's fine. It might not be better than hers, but she's not available at the same time.
It's not
I'm here right now trying to get it for you, right? And so here's the deal. You've been buying $5 a day in pasta from me because you're just like, Chuck, this is the best.
This is a hypothetical. Wow.
It's the best. I'm loading up. I'm backing up the truck.
$5 on anything a day.
And finally, you get to the point where you're like, you know what? inflation's going on, wallet's getting a little thin. Chuck, I don't know if I can do it. Now, meanwhile, I've been raking it in because it only cost me $1 to make the stuff. It's like I'm good at it, but mostly I'm good at making money off you. And I go, Mark, you know what? How about this? I'm going to give you $25 so that Monday through Friday next week, you can buy my pasta. I'm vendor financing your purchases because I know that you love it. You just need a little help getting over the hump. I'm going to do that. I give you $25. Next week, you give me $25 and I give you a bunch of pasta. Net, I'm out a bunch of wheat and eggs and flour and everything. And you're sitting there saying, I didn't have to pay a thing. That doesn't fill me with confidence when instead of pasta, we're talking about $40,000 semiconductors.
Yeah, I think the issue here for me with, and I don't know enough about this to say something I'll just a little caveat. I'll just speculate. It does feel a little bit like they don't have anything better to do with their capital, like, well, buy back shares or make an investment in, they have in the next generation chip development technology or whatever. That's incredibly vague.
Because they need the number to go up.
Yeah, they're beholden to these very aggressive growth forecasts. We all know they can't hit them indefinitely for reasons we talked about in the last hour. A company can't grow faster than the economy or the market on average, for that matter, forever. So it does seem a little bit desperate, but at the same time, in the comparison to vendor financing, I just don't know, because that's viewed as a legitimate sales tool. I mean, it happens, for example, when you buy a car and Carvana, I don't know, finances it with their captive arm, their captive financing arm.
Let's take a quick break. When we return, we got Wall Street Watch and the trivia answer.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest risks to retirement isn't just market volatility, it's longevity. People are living 25 to 30 years after they stop working, and that gives inflation plenty of time to work against you. At just 3% inflation, your expenses double in about 23 years. Add to that the fact that healthcare costs typically rise faster than general inflation, and your later years could be your most expensive. Without a plan, that combination can put real pressure on your savings. That's why we've put together a brand new guide called Inflation in Your Retirement Plan. The guide shows you ways to balance longevity risk with rising costs and strategies that may help you make your money last through decades of retirement. Call 800-393-4001 to get your free copy today. 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Marc became familiar with after his military service ended back in 1984. As Marc built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Marc works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Marc Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about choosing beneficiaries for your IRA. Todd, what is the best way to set up designated beneficiaries for qualified plan assets from both a Medicaid and estate tax planning perspective for a married couple?
Generally, for a married couple, you have several choices. The most commonly used one is you're going to make the surviving spouse the designated beneficiary. It doesn't shelter assets from estate taxes. It just passes to the surviving spouse. It avoids probate, and it's probably the best way to go from an income tax perspective, not necessarily an estate tax perspective. Another way would be you could technically name the trust the beneficiary of the IRA when you pass. That at least will help it shelter assets for estate tax purposes and still provide for the surviving spouse. But from a Medicaid perspective, it will then protect it from the nursing home, but it'll take 5 years. Perhaps the newest and best way to do this would be to name the estate the beneficiary, provided you are over age 73 or over. That way, it goes through probate into the will. It is sheltered for estate taxes. It is immediately protected from the cost of long-term care for the surviving spouse, and the surviving spouse has access to it as well.
Educate yourself about the estate planning process. Request your free copy of Todd's brand new guide, Why Name Your Estate an IRA Beneficiary, right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, after the S&P 500 snapped a 3-day winning streak yesterday, markets today are a little changed. This morning, we saw more housing data posted where sales of newly built homes rose a much larger than expected 20.5% in August compared with July, to the highest level since January of 2022. That, according to the U.S. Census. Right now, the Dow is down by 0.1% or 55 points lower. S&P 500 also down by about 0.1% or 8 points. NASDAQ also down by 0.1% or 30 points lower. Russell 2000 down, you guessed it, 0.1%. 10-year Treasury yield is up 2 basis points at 4.139%, and crude oil up nearly 2% higher, trading at $64.56 a barrel. Alibaba jumping over 9% after the Chinese tech company said it will boost spending on AI models and development to more than $53 billion. Sticking with tech and AI, where Micron Technologies reported its revenue soared 46% in the previous quarter, driven by demand for AI developers. Micron's outlook for the current quarter also beat expectations. However, that stock is retreating about 2%. Meanwhile, shares in Lithium Americas surging 97% now after Reuters reported that the U.S. is negotiating a stake as large as 10% in the Canadian mining company. Lithium Americas is also developing a mine with General Motors, sending shares in GM up by about 2%. And according to Bloomberg, Oracle is seeking to borrow $15 billion from the U.S. investment-grade bond market today as the software maker ramps up its spending to meet the needs of the AI boom. Oracle shares are down about 2.5%. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question: which actor portrayed Darren in the 2005 movie Bewitched? That would be Will Ferrell. Charlie from Scarborough, Maine is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Charlie. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Can we talk a little bit about that GM Lithium Americas item?
Let's do it.
The one that Tucker just brought up. It's not in your stack.
Oh, good.
Yeah.
Thank you.
Basically, Tucker, correct me.
I'll look at that later.
What you just said was that GM is going in on that mining venture with them?
They are currently developing a mine. Yes. That's what I've read.
What a horrible idea.
What, vertical integration?
There's a reason why automakers don't do it for their raw materials, is because they have no expertise and specialization in doing so.
I think of Henry Ford when I think of that. Didn't he buy rubber plantations?
So he went further than that. He bought land in Brazil and tried to set up a commune called Fordlandia that was going to basically produce the rubber and other raw materials needed and send it up to the U.S. for production and everything. It wasn't quite like it wasn't, it didn't go as badly as it could have, in that like not everybody died, but they shut it down within a year or two because they were like, this is horrible, it's not working. Why? Because you have no expertise in doing any of this stuff. So I have no doubt that GM is looking at this saying, well, we're going to need the lithium. Why don't we, help develop, the venture and everything? Like, I'm sure it comes from a place of good intentions, but if that's the case, hey, why don't you also own a bunch of iron mines and a bunch of steel smelters and, all the stuff that, why don't you go and, buy a bunch of rubber trees?
Sounds very 19th century, doesn't it?
What makes lithium different that you feel like, hey, we've got some way that we can do it that's better, when you clearly don't? So the nicest thing I can say about it is, at least this is kind of an ancillary business. It's not like, you remember when AMC got all that money from an equity raise and they went out and they bought like a gold mine?
Yeah.
It's not that, at least. So you can at least say it's at least an ancillary business. Like AMC does not need they don't need to mine gold in order to show movies to me. This, you could say, okay, like I understand their thinking, but historically there's a reason why automakers are not involved in the production of the raw materials needed to make their cars, and that is they're not any good at it. So who knows if GM's identified that this is actually, viable and useful. Who knows that this is going to actually end up working out well for them. But whenever a car company in particular gets outside their comfort zone, immediately I'm just like, nope, you're going to need that capital for something else. Running a car company is expensive. Don't go doing dumb stuff. It's kind of where I get to there. I don't know.
Yeah, I could see that.
Let's talk about this piece here. Actually, yeah, let's talk about this. Is the diversified portfolio dead? The AI boom has turned an age-old investing rule on its head. Couple things. This piece largely talks about, some studies that have been done on more concentrated portfolios and whether or not that's good or bad. And the answer basically always boils down to, hey, if you have any actual investing skill, it's good, but most of us don't have investing skill, and so
thanks.
It's bad.
Yeah.
That's kind of where it gets to.
Right.
The other piece, like they quote, Warren freaking Buffett, which, like, quoting Warren Buffett on investing and saying, hey, you should do this, is like quoting Ted Williams on baseball and being like, oh, like, just do that. Like, yeah just because it worked for Ted Williams doesn't mean it's going to work for you. Like, these are generational talents at their respective trades, and you should not take advice from, like, the best person ever at any specific thing because it usually doesn't apply to you.
Yeah, hard to operationalize it when you don't have their level of skill. If you substitute for 60-40 just the generic term diversified, the answer is yeah, probably. If you're older, for example, well, you probably need some growth and inflation protection. Stocks have historically been good at those things.
Sure.
But you might also need some money to meet short-term needs, educational or other expenses that will arrive in the next several years. Well, you might not want to put that money in equities, in stocks, because stocks can experience serious drawdowns, price declines, and they can sometimes last for a while. So, of course, most investors should be somewhat diversified. Arguably, every investor should, except for people with an extremely long time horizon. Some investment folks, not all, but some would argue that they can afford to be entirely in equities and even borrow to buy more.
Hey, this fall, why just watch the leaves change? when you could watch the sunset over turquoise waters? Well, the U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then explore Charlotte Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry over to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean, the U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
One other piece here, whenever I see something, a piece that's written talking about, hey, you know, because of XYZ doing so well, does that mean you shouldn't diversify? Usually means that XYZ, whatever it has about run its course.
Yeah, you could write a piece like that every year. Just substitute a fill in the blank for XYZ. That's why
whatever
you said
the best
XYZ.
whatever the best performing sector is, because generally, if you look at the history of the S&P 500, hey, you might have a trend that lasts like 2 or 3 years. That's kind of a longer term one. But generally, the best performing sectors in the S&P change every year, and you have no idea what they're going to be based on how the prior year went. So when you see something being like, oh, should you like not diversify and just invest in AI? It's probably not like... Why weren't you writing this piece 3 years ago is the question that I would ask.
Yeah, I know. It's not clear to me who they're writing for. For an individual investor, that is incredibly bad advice. If you're a family office, which is an investment advisor that runs money for one or more very wealthy families, or if you're running a hedge fund, which is an unconstrained type investment strategy, usually catering to wealthy people who can afford exotic forms of risk, well, they tend to not be diversified, and they use very unusual skill in unusual ways. But for most of us, for nearly all of us, the rules of thumb you learn about when you go to your first 401k education session, when you sign up for your plan or you're signed up for it, those will apply for the rest of your lives.
Piece in CNBC, an exclusive from them, Ford courts riskier borrowers with lower rates for F-150 pickups. I'll quote here from the piece. Ford is racing to sell more F-150 pickups this quarter by offering lower interest rates to buyers with the weakest acceptable credit histories. So this, I guess, is Ford's version of like a buy now, pay later, and that they're going to let you buy now and Ford's going to pay later, because if Ford wanted to offer these rates all the time, they would do so. They're doing so now because they want the money from the F-150 sales today, probably because inventories are building would be my guess. And in return, they're willing to accept lower interest payments and probably higher defaults as a result of this.
Yeah, I guess it depends on what happens in the broader economy. If things go south, those defaults will pick up, and this will seem like an incredibly ill-advised and, in retrospect, ill-fated move.
Whenever we see something like this, it's just like, okay.
I know, it feels
I always come back to, look, basically every bubble in history has been caused by two things, securitization and leverage, and this is the leverage piece. It's, are you, levering up people that can't afford to make the payments, and are you going to end up in a problem?
Well, yeah, they're by definition, they can't afford it. That's what credit rating scores exist for. It's not to make life hard for us. It's to make sure you don't overextend yourself.
Yep. Yeah, it doesn't fill me with the warm and fuzzies.
No, it sounds like a terrible idea. Honestly, I hate to be a party pooper. Maybe it works out, but odds are it doesn't, right? For the people who are induced into borrowing huge amounts of money to pay for these beautiful vehicles, who wouldn't want one? But, it's probably not the right thing to do.
Let's take a quick break. When we return, Stack Roulette.
Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Artificial intelligence is changing the way companies invest and how markets move. Add to that global trends like international outperformance, a weakening dollar, and shifting bond yields, and you've got a complex landscape for investors. This is Mike Armstrong from the Armstrong Advisory Group, and we're hosting 2 financial seminars this fall to help you understand what it all means. Join us at Margaritaville Resort, Cape Cod on October 9th, or at the Showcase Superlux in Chestnut Hill on October 16th. Call 800-393-4001 to reserve your seat. We'll talk about how diversification and preparation may help you navigate uncertainty so your plan is ready. Don't miss this chance to get a clearer picture of your financial future. Register today by calling 800-393-4001 or on our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. This month's free guide from Cushing & Dolan is called IRA and Life Insurance Planning, Estate Tax Strategies and Nursing Home Protection. Learn how naming your estate a beneficiary can reduce estate taxes, protect assets from nursing home costs, and avoid the 5-year Medicaid waiting period. Call 866-848-5699 to get your free guide today, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
This fall, why just watch the leaves change when you could watch the sunset over turquoise waters? The U.S. Virgin Islands are your perfect fall escape. Set sail on the sparkling blue sea, snorkel colorful reefs, kayak through calm lagoons, or try to reel in the big one with world-class sport fishing. Then, explore Charlotte-Amalie, the capital of St. Thomas, with its historic streets and duty-free shopping. Ferry to St. John's Virgin Islands National Park for hiking and secluded beaches. And finally, experience the culture, festivals, and rum of St. Croix. 3 incredible islands, countless experiences, and something for everyone to enjoy. With easy travel from New England, no passport required for U.S. citizens, and no money to exchange, paradise is closer than you think. So why wait? This can be the season you fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. The U.S. Virgin Islands. Plan your getaway now at visitusvi.com. That's visitusvi.com.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts, and this year's DAV 5K on Saturday, November 8th at Castle Island is sold out. But you can still take part by making a donation to support our great American heroes. Please visit dav5k.boston to make your gift today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston.
Mike, what do you got? Or Mark? Whoever you are.
Well, Chuck, I want to tell you how handsome I am today.
Is that your Mike Armstrong impression?
Yeah, it's because I can't do him well. He's way too low for me.
I don't know.
That's close as I'm ever going to get.
Okay.
And if we could not let him hear that, that would be wonderful too, Tucker.
He's listening. He's listening right now.
If we could dump the last 20 seconds or 2 hours.
He doesn't listen to the show. It's okay.
From the Financial Times, this speaks to the challenges that all developed countries are facing, with a larger number of retirees being supported by with the growth rate of retirees growing faster than the growth rate of people still in the workforce. This story is about Italy. Italy weighs freezing its retirement age at 67. The Meloni's government, Prime Minister Giorgia Meloni's government, is considering making this change. The reason I bring it up is that I was surprised to find out that Italy's pension law links the statutory retirement age to life expectancy improvement. So it goes up automatically, whereas now their pension law governs relationships between labor and
it's more
companies.
Broad than what we're talking about with Social Security.
Very much so. The closest analog we have is Social Security's normal retirement age, which by coincidence is 67. But what sort of impressed me about Italy's system, if you will, is that it escalates automatically. Ours has to be, increases in our NRA under Social Security have to be legislated, and the Prime Minister is under pressure to put a ceiling on that because obviously older folks are squawking. I was also a little bit surprised to learn that the number of people over 50 still working in Italy, or the percentage, is nearly 50%. Whereas here, our 55 and over labor force participation rate is about 40%. So for what it is worth, firstly, we're all facing the same challenges in the developed world. More people retiring, fewer people working, or a higher growth rate in the retirement age part of the workforce than in the overall workforce. And the fact that Italy's laws are a little bit, or practices are a little more stringent than ours as I read this.
I want to talk a little bit about this 11-year, $111 billion media rights deal for distribution. And the league has an opt-out clause after the 29-30 season, which is 4 years from now. And Roger Goodell, the NFL commissioner, said this yesterday: "I think our partners would want to sit down and talk to us at any time when we continue dialogue with them. I like that opportunity. Obviously, it's not going to happen this year, but it could happen as early as next year. That could happen." So, obviously, you start to say, okay, why do the owners want to renegotiate the rights deal today? You know, what gives? Like, what's the reason? And the obvious answer that you come up with is, well, they think they can get more money for the rights today as opposed to where it was 4 or 5 years ago. Couple things that go through my head. The first is, look, you obviously went through a substantial bout of inflation since this deal was signed. Prices in general are higher, and so the owners look at this and say, great, like we locked in prior to that. We want, more than we were getting, and we think instead of getting, $10 billion a year in this media rights deal, maybe we can get, 12 or 13. So it's, 20, 30% higher. Okay, like I understand that, but again, why now? Like what? Why not last year? Why not next year? Like, why now? What's the reason for this? And the only piece that I keep coming back to is there have been a couple of things written about this to a certain extent where when you look at the price of pro sports teams today, it's basically at the point where individuals can't afford them. You have to have these consortiums or a bunch of private equity money or sovereign wealth funds from the Middle East that come in and are able to do this. And in order to entice some of those groups, most notably the private equity firms and the sovereign wealth funds, you have to actually show that you can make a return on the investment. The Norwegian sovereign wealth fund or the Saudi sovereign wealth fund doesn't want to invest in an NFL team just so that they can go to the games in the owner's box on Sunday.
No, it's not about
that. They don't need that in order to have their place in society. It's not, Daniel Snyder buying, the Commanders being like, I'm the biggest fan ever. It's no, they don't care. They just want their money.
Right.
So when you look at this, I think part of it that I come back to is, hey, because these teams need to have their value continue to go up in order to make like the whole thing work, you've got to have a faster negotiating cycle and more money coming in on a more rapid basis, and that's where I think the impetus is for the owners on this. Let's take a quick break for the rest of the day. We're going to be back at it tomorrow. We get some jobless claims and existing home sales data. We'll fill you in on all that and more tomorrow.